Back in 2021, someone had reached out to our office. He was interested in a whole life insurance policy to maximize the cash value and then to use it for real estate. His goal was to fund the policy aggressively for a short period of time. You'll see that it was for about 5 years, and then have a large pool of capital that he could use for real estate opportunities as they came around. So now we're at the end of 2023, and he's interested in using his policy because he's funded it for 3 years. So he has a little bit more than $200,000 that he has access to. So what we're going to look at in today's video is first the original plan, how much he's funding his policy with every year, how many years he plans to fund his policy for, and second, using the policy specifically for real estate. And we'll go through some of the important questions to ask or make sure someone is asking for you when you're interested in using a policy for real estate. Really what people are most interested in is making sure that the actual growth rate or the dollar amount you're receiving from that policy is equal to or greater than what you're paying the insurance company in loan interest. And we'll go through exactly how you can see that year by year. So to go back in time, back in 2021, when he connected with our office, he was 44 years old at the time. He was interested in a whole life insurance policy because he wanted to build cash value and again, use it for real estate opportunities as they came around. Now, his priority was maximizing the cash value, meaning the reason he's putting money into a whole life insurance policy was not primarily for a whole life insurance death benefit. The death benefit is nice, but what he was primarily interested in was cash accumulation, maximizing that cash value so he could access it whenever he wants to. So what he funds his policy with is $75,000 per year, and the original plan was to do this consistently for 5 consecutive years. How much money is that? Well, $75,000 over 2 years is how much? $150,000. So over 4 years, how much would that be? $300,000. So over 4 years, it'd be $300K plus 1 more year is $375,000. That's how much he wanted to get into the policy aggressively upfront and then have the option to stop altogether, or if he has the ability to and really likes what he's seeing, he can keep on adding money. But he wants to make that decision when the time comes, and he does not want to have to commit to a large premium bill or making premium payments forever when first starting the policy. So we set it up just like that, and we'll look at examples of stopping the policy, the funding altogether that is, after 5 years, and then what it looks like if he keeps on adding money. So what I want to hit on first is how we set the policy up. And this is the most important part in my opinion. If the policy is set up correctly or designed correctly, this is really what ensures you're going to have the maximum amount of cash value possible. If life happens, you put yourself in a solid position where the policy is the least likely to lapse. And it's also very flexible. I'll talk about that when we look at the actual numbers. So let's talk about the policy setup here, because the amount he's funding is $75,000 per year. So when you see whole life insurance and funding $75,000 per year, as far as the payment requirement, what do you think it is? If you're new to this, that is. Probably $75,000. That's what I thought when I was brand new to all of this. Whatever the premium bill is, that's what I have to pay. Not really the case, not if you set it up correctly. So with the $75,000 per year going in, that's what he's funding. But did you know, when you pay money into a life insurance policy, you can actually choose where your money goes. First, we've got the premium piece, and then second, we've got the PUA rider. How I like to refer to these two guys is as follows. The premium, I like to call the initial insurance expense. And then the PUA rider, PUA stands for paid up additions, I like to refer to as a cash dump-in. Here's the reason why. With most whole life insurance policies, whatever you have going into the premium, notice here, it's 10% of the total payment, but the premium does not show up in cash value. Not for the first year, and sometimes the second year. With his policy, premium dollars did not show up in cash value during the first and second year. He has a traditional whole life 100 policy. I'll explain what that means in a little bit. But years 1 and 2 of his $7,500 premium payment, nothing shows up in cash value. The reason why, from the insurance company's perspective, is because they are overcharging us for the cost of insurance or the death benefit up front. Then we've got PUA riders. And I like to refer to this as a cash dumping. Why is that? Cash dumping, because I feel like we're dumping money into the cash value, baby. So here we've got $67,500, which is 90% of the $75K per year we're paying into the policy. Whatever we pay into the PUA rider shows up in cash value. This is money we can access right away, begins compounding via dividends and interest. You'll typically see of whatever you add to PUAs between 90 and 95% show up in cash value immediately because there are fees assessed to our PUA payments, but we do see the bulk, again, show up in cash value right out of the gates. This is really the key to maximizing the cash value of a whole life insurance policy. So when we set these up, what we always like to aim for is understanding the limits that each insurance company offers and how low can we set that premium. Because we know that this takes the biggest bite out of cash value immediately, and then how aggressive can we go with the PUA payment. And you see this 1090 here, this 10% premium, 90% PUA. That's often about as aggressive as we can go, especially with some of your major mutual companies like a Mass Mutual, Guardian, New York Life, and Northwestern Mutual. It's not a clean 1090 across the board, but you'll see it very close to that ratio with a lot of the top companies. So looking at these two areas, which one maximizes the cash value? This guy. So naturally, we want to get as much money into this rider as we possibly can. So of the 75K, you've got 10% going toward your premium, or he has 10% going toward his premium, and the other 90% toward PUAs. This also creates a very flexible policy. Here's why. The premium piece is really what's due. PUAs on top of the premium piece can be made at your discretion. So what this means is if he runs into a rough patch or just doesn't want to fund the full 75K on any given year, he can always scale that PUA payment down and then increase it again in the future. My point is we can make it very flexible. This way we don't feel like we're on the hook to make a $75,000 premium payment every year. No, we don't have to do that. What a lot of people will actually do is set up a policy like this, for example, where they're only billed for $7,500 per year, and then add additional funds to PUAs at their discretion through their online portal, mobile app, maybe it's a wire transfer. The flexibility of the specific insurance company you choose is very important there. But my point is you can set up a policy to do that if you like that funding flexibility. So again, policy setup is the most important piece. This will typically give you maximum cash value, that 10% premium, 90% PUA. And if you just want a quick eyeball test, if you're thinking, okay, how do I make sure that a policy is designed correctly or set up correctly? Here's what I would look for. In the first year, I should see anywhere between 80 and 90% of my total funding amount, my total payment, show up in cash value. That's in the first year. And then second, I should break even, which is when I get all of my money back. Somewhere between 3 to 5, sometimes it's 3 to 6 years, maybe if I've got a health issue or I'm a little bit older, but somewhere in that range. So let's take a look at his actual policy. And what we're going to look at here too is also how to measure the growth in dollars when we look at your cash value growing each year. So what we've got here is his policy that was started back in October of 2021. And what's highlighted in that beige color up top, years 1 through 3, represent what has already happened. So he's already funded $75K per year for 3 consecutive years. And what we've got, years 1 and 2, are the actual cash values. We pulled these straight from his annual statement. And then this cash value, $211,424, is what his cash value is projected to hit at the end of this policy year. So as we look at this, we've got $75K per year for 3 years. Then what do you see afterwards? $75K, 2 more years, and then what? $15,000 per year indefinitely. Remember when we said he wanted the option to continue to add money to the policy? This is displaying exactly that. Now he doesn't have to fund $15K. It could be $7,500. It could continue to be $75,000 if he'd like. He's got a lot of flexibility to continue to add money to the product. However, in this option, we're looking at what the values might display if he continues to fund $15K per year. Now, with that said, let's go back to the original plan, which we see a lot of people interested in, which is stopping funding after a short period of time. So here, we are stopping the funding altogether when? After 5 years. Let's measure the cash value growth here. And then we'll look at using the policy for loans. So pretend this is you. You start a policy. You fund $75,000. The first year, you have $65,000 in change in cash value. What's your growth that year? Nothing. We take a loss of $9,300. This is important to mention because a lot of times when we see a dividend rate with a life insurance company, let's say it's 6%, common sense would tell you and I that if we put money into any product that has a dividend or any interest rate of 6%, that our money is going to grow by 6%. However, with a life insurance policy, that will not be the case. The dividend rate does represent the crediting rate that's applied to our policy. However, you also have the cost of the life insurance too. So how I like to explain a dividend rate is that it is always a gross rate that is applied to our policy after the insurance company's expenses and everything that comes with the life insurance policy. So in this example, first year, we've got a loss of $92.98. Now look at the year 1 cash value. You're at $65,702. If you add $75,000 to $65,702, what would it be? It would be $140,000, $140,702 to be exact. So that's if this was just under your mattress and you added 75 grand to it, it'd be worth $140,000. That'd be a really nice mattress. But here, your cash value is worth $134 and change. That means you got less back than what you paid in. You took a loss there in the second year. Why is that? Well, the reason why, because of that $75,000 per year, the first 2 years, the premium piece of $7,500 did not show up in cash value. That's the main reason why. That's what's taking the biggest bite out of your cash value in that first and second year. However, look at the year 2 cash value. You're at $134 and change. You add 75 to it. If you add $75,000 to $134,000, what would you come up with if you have a calculator or if you're really good at math? It'd be $209,000. What do you have in cash value? More than $209,000, $211,000 and change. What that means is the third year, you got your full $75K back and a little bit more on top of it. This column here represents the net amount you're getting from the life insurance company each year, $1,910. That's the total amount you receive from the insurance company, and that is the net dollar amount. Then each year, what do we see happen? Well, it gets better and better. What's highlighted in yellow represents your break-even point. That's when you get your money back. Notice it's between 3 and 6 years. Here, it's between years 4 and 5. You're very close. In year 4, in year 5, you are positive. You've got a gain on your cash value, more than what you've paid in. And then if you do nothing, it continues to compound. What we did here too, after year 7, is reduce the death benefit. The 7th year has to do with a MEC test on a life insurance policy. I won't get into the weeds of that today. My point is, this is optimized for cash value. So this goes back to what? The most important part, setting it up correctly from the beginning. Because if it's set up correctly from the very beginning, what happens? We've got as much cash value as you could possibly have from the beginning, which now you can use for other opportunities. Let's now look at using it for other opportunities. And we're going to look at what your net cost to borrow is too, because this is a very important point to hit on. So we're going to look at this exact illustration. And by the way, here's the actual detailed ledger from the insurance company. So we can see the premium up here of $7,500 and change. Then we're just plowing everything else into PUAs, and the cash value looks quite attractive. But loan time, here we go. A lot of columns here. I'm going to walk through them one at a time. So on the left, under policy values, we've got the illustration we just looked at, and this will give you the same cash value, death benefit figures. The only difference here is that you've got your annual rate of return. So instead of seeing your growth in dollars, you're seeing it in percentages, which some people prefer. If you're working with us and you'd like one or the other, we can show you one or the other. We can also show you both. It's quite simple, but whatever you prefer, we can always show you exactly that. But first year, that $9,300 hit came out to a negative 12.4% return. That's what it comes out to. When you pay in 75 and you've only got 65,000 in cash value, the loss comes out to a negative 12.4% hit. And then we see year over year what it looks like as time passes. Okay. What we really want to look at though is what's his net cost to borrow. So this illustration, what it represents. You've got your cash value right here. This column, LTV at 95% of cash value. This represents very close to the maximum loan you can take against your life insurance policy. So he's in policy year 3 right now, $211,000 in cash value. 95% of that is almost exactly $200,000. So if he's got an opportunity right now where he wants to use his policy, let's say he wants to take out $150,000, what does that look like? Because right now, his policy loan rate is 5%. However, on his policy anniversary date in October of 2024, it's probably going to be around 6% or so. Maybe a little bit less or a little bit more, but probably close to 6%. It is a variable rate. It can adjust one time per year with his policy. So we want to make sure we factor that or account for that. But again, if he takes a $150K loan right now, if you look at your loan rates compared to your annual growth, is the growth rate ever higher than the cost to borrow? No, it's not. Not even at its peak in this illustration. However, what we always want to keep in mind with a life insurance policy, when you take a loan, you're going to continue to earn dividends and interest, or call it this net growth rate, on your entire cash value, even though money's outstanding. So let's take a look here. Let's take $150,000 this year, and then let's do what a lot of people do, which is while they continue to fund the policy, pay interest only, so not make any principal payments. And then when he's done funding the policy, he'll begin to repay the loan. Let's look at $25K per year, just to make it simple and not super aggressive. Okay. So here's exactly what people like to look at, including myself. Year by year, What is my cash value growing by? The rate is beneficial to look at, but the dollar amount, in my opinion, helps a little bit more, or it's easier to follow. Here's why. I can look at year 3 when I take that $150,000 loan. I can look at the rate, but when I look at the dollars, I see that my growth was $1,910. What I paid in loan interest was $7,500. I'm in the red that year when I look at it. How about the next year? My growth was $6,800. What did I pay in loan interest? $9,000. Why is it different? Because my loan balance has not changed. It's still $150,000. Here's the reason why. The first year, the loan rate was 5%. 5% of $150,000 is $7,500. The next year, we're assuming the loan interest rate goes up to 6%. 6% of $150,000 is $9,000. How about the following year? $9,000 interest payment. What's your cash value growth that year? $10,000 and change. Let me clear everything above it just to make it easier to follow. There we go. So in year 5, when you are not making any loan payments yet, your cash value growth is exceeding what you're paying in loan interest on a yearly basis. How is that? Because you have a 6% cost to borrow and your net growth rate is not even 3%. Here's how. That 3%, or the 2.96, is on your full cash value of $379. That's what comes out to the $10,900. Where the 6% is only on the $150,000. That's why. So this is a big reason why I like these calculators, because we can just see the amounts in dollars. And what a lot of real estate investors like to do is make sure they're always putting themselves in a position where they're not in the red. Or if so, it's for a very short period of time. They want to make sure they use this tool to their advantage and not find out of some surprise that they've got to pay, that they're paying more in loan interest than what they thought. That's where people get upset. So we don't want that to ever happen to anyone. So in this example, when we repay it at $25,000 per year, we pay it off by year 11. Notice when you are repaying it, the loan balance is going down and your equity is being restored, just like a line of credit. And we can see year over year what we're gaining on our policy and then what we are paying in loan interest. Some like to look at the far right here, which shows the total interest you've paid compared to the total gain on cash value. Oopsie daisy. So at the end of this, you've gained almost $100,000 and you've paid about $48,000 in loan interest. When does it catch up? Year 7 in this example, which is only about 5 years here, year 5 through 7, because we took the loan out in policy year 3. Purpose of this, again, is just to see what are my gains compared to what I'm paying in loan interest. Some people we work with are very hands-on. They like to plug their illustrations and numbers into this loan workbook. Others we work with say, can you just tell me what the numbers come out to? Do it for me. This way I know I can make the best decisions. The answer is yes, we can help you in any way that we'd like. So I do hope that you enjoyed this video. If you did, please let us know. Please hit the like button, subscribe for more. And as always, I hope this helps. Thank you so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.